Welcome to Early Edge Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20 factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
So today we are going to analyze Siyaram Silk Mills Ltd. It is a textile manufacturing company and is engaged in manufacturing fabrics and ready-made garments, especially the menswear section. The company exports to countries like UAE, Australia, Bahrain, Bangladesh, Cambodia, Canada, and etc. So this is their board. It composes of the Poddar family mainly and their experienced professionals in this field with a lot of quality management and other expertise. So the company plans to serve multiple end markets through their different brands and sub brands. These are some of their fabric brands. As we can see, it starts with some of the popular names are J Hampstead, Cadini Italy, and Raven Linen. Also, some of their garment brands includes Oxemberg, J Hampstead, and Siyaram Mozzo among the popular ones. So they have got in-house design studio and top-notch technology in using which they provide a variety of products including wool blends, 100% cotton products, blend bamboo fabric products, terry rayon products, cotton blends, and also 100% linen and linen blends. Now, they are planning to create value across the Indian fashions ecosystem, according to some of the industry data. So, the fashion industry is currently at around 84,860 crores, and it is expected to grow up to 4.24 lakh crores by fiscal year 2031. And in 2024, the fast fashion segment grew by 30 to 40%, whereas the overall fashion industry grew by only 6%, which shows that there is a higher concentration of the fashion segment, which is growing at a very steady pace. And with 50% of India's population under 25, the country has strong potential for growth in the segment, driven by a young and trend conscious consumer base. Also, in the ethnic wear industry, the Indian market has around 2.4 lakh crores, which is expected to grow up to 3.3 lakh crores by 2029. So a CAGR of 7%. And this men's ethnic wear contributes around 10% to the overall ethnic wear industry. And the key growth drivers includes rising demand for ethnic wear during various celebrations and festivals. So in this both these segments, Siyaram has got an advantage using their brand recall, in-house design team, and their deep retail knowledge and efficient operating model, along with the supply chain automation systems. Now the company has entered into newer segment of their business. Earlier on, they had majority of their business coming from the fabric segment, but now they are forward integrating into making garments. So they have entered into two segments currently. One is the ethnic wear representing DEVO, and one is the fast fashion Gen Z brand called ZECODE. So the ZECODE is targeting urban shoppers with trendy and affordable apparel, and as of 2025, there are 12 stores opened, and they plan to open 20 stores more in fiscal year 2026. And regarding DEVO, it's the ethnic wear segment that celebrates country's rich cultural heritage and traditional style preferences. So they have around 7 stores opened until now, and they plan to open 15 more in 2026. Now, the stores are placed in high footfall areas to boost brand visibility and connect with more consumers. Also, they're using billboards, hoardings, and small on ground events to boost brand recall and engage with the customers offline. And they're actively engaging on social media and digital platforms to reach a wider and younger audience. Some of the metrics of the fast fashion brand Sequoia are as follows. So it's a company owned company or operated store, and they've got two various sizes of stores depending on the location. Also, their price is positioned up to 999 rupees, which is in very close competition with the Zudio. Also, they're targeting the South India's geography because the market is underserved and there is high potential for growth. Also, they are spending around 1 to 1.5 crores for both ZECODE as well as DEVO, and their target customer is the Gen Z audience. Now, coming to the DEVO, so it has a similar store format and investment per store. So they are trying to position themselves into mid and premium segment with their prices ranging from around 2000 rupees to 12,000 rupees for each ethnic wear, and their targeted geography is North India, and their target consumer base is men. Now, the revenue breakup is as follows. So, as of 2025, a majority of the revenue comes from the fabric business, and then constantly increasing share in the garment business. And there are it's this other segment which is also growing. So there has been a 6.4% growth, which is quite less, but is decent compared to the industry standards. Also, they're trying to grow rapidly in the garment segment, so that is something that needs to be focused on. The operational metrics are as follows. So they have reduced their net debt significantly and have a lot of investment in liquid funds, which they would use to further expand. They have an asset turnover ratio which is constantly declining over the past 3 years, but it's still not that bad. So it's around 1.27 right now, and the return on capital employed is 24% and return on equity is 16.4%. So that's okay. And the fabric business grew by 5.8% since 2024, out of which volume growth was 6.9% and the value growth was minus 1.1%. Also, in the garments business, in fiscal year 2024, it was just 2,729, which grew to 2,870 crores in 2025, out of which we can see there has been both volume growth as well as value growth. And export contributed around 9% of the revenue, and their revenue growth has been driven by volumes and supported by market demand and efficient operational execution. So these are some of competitive edges with the company experience. They've got a very traditional marketing approach which positions themselves well among their consumers. They've got a proven track record, and their new CRM 2.0, which is their entry into the garment segments with C Code and Devo, provides huge opportunity for growth. And they're focusing on innovation and quality experience with a well diversified product mix. They plan to give very good shareholder returns in the upcoming years. Some of the Conquel highlights are as follows. So the company launched two brands which we already discussed, and they have 19 stores right now, seven of Devo and 12 of C Code, and they are planning to open 35 more in 2026. They adopted the COCO model, which we already discussed. So the plan was initially to retain control, test performance, and improve store operations because this would be margin accretive, so that's why they took this approach. And ZECODE is primarily focused on South India, especially in Bengaluru and surrounding tier 2 cities. And Devo is targeting North India with Delhi plus UP region, both under a clustered approach of stores. Also, the pricing of Devo, which we discussed, is around 2000 to 12,000. And for ZECODE, the pricing remains on a 999. The fiscal year 2026 CapEx plan is 50 crore for retail stores. They plan to open 35 stores and 40 to 50 crore for traditional business, which is their maintenance CapEx. The EBITDA margin guidance for fiscal year 2026 is around 14%, absorbing early losses of around 100 to 150 BPS from the new retail segment stores, and they're targeting 11 to 12% of revenue growth in fiscal year 2026 across traditional and retail business combined. They commissioned captive rooftop solar power generating 50 lakh units, saving 3 to 3.5 per units with an investment of 8 crores. So annually they're going to save around 1.5 to 1.8 crores because of this new initiative. Also, they have invested 200 plus crores largely in short term debt instruments, which will be available as liquid funds. So that's why their net debt is almost negligible. Some of the bull case scenarios are as follows. Their retail expansion strategy and COCO model for quality control is very optimistic. Also, they've got a strong brand recall and dealer network, which positions themselves well. And they've got an asset light outsourcing model with an omnichannel retail presence. They have got the market leadership in branded polyviscose fabric, which is an alternative of cotton. And right now, the cotton industry is also at a very critical juncture where the HTBT ban has significantly impacted, and there are a lot of regulations going on around cotton. So, this polyviscose fabric is gaining traction in this segment. Also, the focus remains on improving store level performance and operational metrics alongside the company's expansion. So, this can benefit the company largely. Some of the bear case scenarios are as follows. So the retail losses from the new stores which they're opening is likely to drag their margins. And so there is high execution risk here. Also, the management is yet to disclose per store sales or profitability metrics. So that is something that remains opaque. Also, the retail entry for a B2B brand might pose huge challenges, especially when they're competing with large scale MNCs which have the pockets to give huge discounts and compete with them to drive them out of the market. Also, they're susceptible to volatile raw material prices and economic downturns, and their exposure to intense competitions and macroeconomic and geopolitical risk is something that cannot be neglected. Also, due to shifting trends and reputational risk that constantly stays, and the business is seasonal in nature, which needs to be watched out closely. Coming to the 20 factor scorecard, they were listed in 2007. They did not have any kind of significant fundraise since then, and they had a share buyback of 108 crores in 2023, which improved the EPS. So I gave them a 5 year. They have got good quality management, so I gave them a 5 year. Now, there are some related party transactions which cannot be neglected. They have got 49 crores of purchases of goods from other related entities and 31 crores of fixed asset from related entities and 10 crores of sales to related entities. So these entities are not the subsidiary, but they are promoter controlled firms. And also there are minor salaries which were paid to KMP related parties, and also they were rent paid and received from related entities. So this is something which we need to further analyze and understand that what are these transactions and whether they were fairly conducted or not. So I give them a 3 here. Regarding board independence and composition, 50% of their board composes of independent directors and with four family on board. So there's decent board independence as well as there is a slight promoter control as well as we can see. So I give them a 5 here. This salary, the CEO or KMP salary is not very significant, and they have almost negligible resignations in the last 10 years, with the last two resignations being in 2016 and 2014. The auditor has a tenure till 2027, and their auditor opinion has been unmodified over the years. They've got a great credit rating from CRISIL, both for long term and short term. And some of the regulatory issues they faced were as follows. In 2021, they were a victim of trademark infringement and counterfeiting. So, some other people were selling products by their name. Also, they've got some IP issues over brand name, which they've won in the court. Also, in fiscal year 2024, Delhi district commissions hold them liable for charging more than the tag price, because of which they're asked to pay 25,000 in fines. It's a very minor issue, but still, I think it's worth noting. So I give them a 5 here, but yeah, we should consider these things. Also, they have all their investor communication and disclosures available. Coming to the financial health in business concentration risk, they sell 96% of their revenue comes from sales to dealers and distributors. And number of dealers and distributors as of 2025 is around 5,731, which is quite big. And sale to top 10 dealers is just 9% of total revenue, with exports contributing around 9% of revenue. So they are highly diversified. So I give them a 5 here. Regarding revenue growth versus receivables, revenue growth has been modest. It's growing at 6%, but the management has given this year's guidance to be around 10 to 12% across the traditional and retail business combined. Also, receivables growth hasn't been quite much, but it's still a higher percentage of revenue. So I gave them a 3 here. OCA by EBITDA is good, so I give them a 5 here. Inventory trends are not that great. Inventory days is 153, which is quite high and it's increasing year on year. Also, DSO is also increasing year on year and it's also on the higher side. So I give them a 3 here. Cash conversion cycle is bad considering the high DSO and inventory days. So I give them a 0 here. CapEx as a percentage of revenue is just 6.4%. Fixed asset turnover is 4. Asset turnover is 1.3. And return on invested capital is 17. The fiscal year 2026 CapEx plan is around 90 to 100 crores, both retail and traditional business combined. So give them a 5 here. Their debt and interest coverage is quite good. They're almost net debt free and their interest coverage is 12.3. So give them a 5 here. Quick ratio and current ratio is also good. There's a huge difference between them because they're carrying high inventory. So I give them a 5 here. Return equity, capital employed, and return asset metrics are good, but they has been declining over the years, so that needs to be noticed. But still, I give them a 5 here. Growth consistency is not quite robust. It's growing at a very modest rate, both the profits and the revenue. So top line and bottom line growth is not that great. So I give them a 3 here. In their governance and promoter behavior, they score 48 out of 50. And in their financial health, they score 39 out of 50. So their final score comes up to 87 out of 100. So coming to their valuation analysis, there were many, like they were selling and buying goods with the related entities. So that's fine that many companies do that. But they're also buying fixed assets from them. So I did not understand why did they need to do that.
So that is one place I would have given a bit lower score because I would want to dig deeper into it. But anyway, the company is trading at 16 PE. They have been giving dividends and they have 218 crores in cash and 5 crores in cash equivalents. So basically, they don't have to dilute for expanding these stores. They have enough investments. So these are the two formats they are targeting. ZECODE, which is more into fast retail. They are mostly targeting south of India, starting with Bangalore. And the second store is DEVO, completely targeted towards in the Delhi, Uttar Pradesh, those city belt. So most of the analysts were focused on asking the growth trajectory for this, launched in 2025. So not even a year has been completed. The traditional business, as you mentioned, the growth is pretty slow. It has been growing at a very slow, steady rate. This jump is because of post-COVID. Yeah, post-COVID lockdowns. But my only concern is everyone is trying to copy Zudio, looking at his success. So we need to see how it pans out. And because of the varying growth rate you have and the difference in margin, it's throwing us variations in number. And also the PE has been all over the place. Let's normalize it first. Let's take worst case, and 12% is a normalized operating margin, and the current price to earning of 15. It gives you a target price of 21. It is trading exactly at 721. So looks like almost everything is priced in. I don't expect the margins to go 35 PE. If it turns out to be like a trend, then yeah, the margins, that the PE expansion can happen. And look what PE expansion can do to the stock price target. Yeah. So growth rate has slowed down. So that is the problem. So we need to see how that pans out. But at what point is Siyaram entering is the bigger question. Even the store format, everything looks a bit like how Trend Zudio does, completely glassed and everything. So
Yeah.
it looks like everyone is following their footprint. Let's try and looking at the reverse CF. Let's take free cash flow to be conservative. They're doing good cash flow conversions. Free cash flow is 132 crores. They're doing net profit of 199. So let's even take 132. Yeah. And a minimum expected return of 20, terminal growth rate of 3, and if we minimum 5 years time horizon and 15 terminal PE. So then the implied growth rate is 25%. Given that they are in high CapEx phase, we need to see like the growth is only going to come from the new format stores and not the traditional business. So need to closely monitor that. But if we are removing the capex and taking or even the net profit of a 199, then the required growth rate comes down to 18 to 20%. And this is what the management has been guiding as well.
Management has been guiding 10 to 12%, so it's still higher.
But then definitely have it in your tracking list. Looks like a clean company, and see how these store formats are playing out. If you're in one of these cities, I would personally go and visit these stores to check the designs and the number of footfalls that are happening. Check Google review ratings as well to get an idea. A bit of scuttlebutt investing does help. I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye-bye.